This video segment will look at a transaction where 25 units of inventory are purchased from a vendor at $3 each. 25 times 3 is $75 that we're going to either pay cash to the vendor, and then second we'll look at paying credit to the vendor, in other words charging it. When you purchase something, it does not involve the sale of your product. You do not generate revenue for yourself, nor do you have a cost of goods sold. The income statement does not change when you purchase something. The change starts with the working capital. We bought $75 of inventory material, so the ending inventory should go up by $75. So it is now 63. It was a negative 12 plus 75 gives you a positive 63. And the overall change in working capital went from 122 to 197. We now have $75 more in our working capital. So that then it should be recorded down here. Now note that it should not be a positive 197. That greatly increases this. It has to be a negative when you go, if I can type correctly, 197. Then you went from your cash, went from 1968 down to 1893. It took out of your cash account to pay for the materials inventory. So your cash flow will go down. The other two stay the same. So the change in cash over the time period went from 88 down to 13, a $75 difference, and the cash on hand then goes down to 10,213. That is the cash flow statement. This also affects the balance sheets. We started with cash of 10,288 here, or it shows it here. Now it's 10,213. Inventory materials was 1008, it's now 1083, so we changed that. And you will note that we subtracted 75 from cash, we added 75 to materials, so it cancels out each other. The total stays the same. It's an exchange of one type of asset, cash, for another type of asset, materials. The assets within the organization are the same, the total. So the total is still 39,544 as it was here. There's no change in stockholders' equity or liabilities. That is still 39,544. None of these are affected when we pay cash. Now let's start over and see what happens when we pay with credit. Again, no change in the income statement. This goes up by $75, just the way it did when we paid cash. The inventory on hand goes up. Ends up, did I make sure I did that right? 63 plus 12 is 75. It looks good. Now we're going to charge it, so it's money we owe. It's accounts payable. And that's a negative value since it's a liability, so we actually put in a minus 75. It goes up by 75, but it goes in the negative direction. And so the change here is 113. So this went up by 75, this went down by 75. The net change is 0 in working capital. We exchanged one type for another. We didn't pay anybody any money, no cash flowed. So the effect on the cash flow statement is going to be this. This stays at 122, no change, and that's the only thing that is affected by this purchase. And so the balance down here is still 10,288. It does change down here a little bit differently. The inventory materials goes up by the $75 that we now have in our on our shelves. That goes up to 26.9 from was 25.94. Where's the accounts payable go? Well, that's a liability. We owe more money. It was $930. Now we're going to say we owe $75 more. So that's now $1,005. And if you look at the bottom now, both of these total to $39,619. $75 greater than previously, where they were $39,544. So the change with a credit purchase is that we now use accounts payable instead of taking it out of cash. That completes this transaction.